And good afternoon. Hope everybody's having a fantastic week. This is Randy Sadler with CIC Services. I'll be your host today and honored to have you on our webinar. I'll be joined by Sean King as well. Tom King, I'm sorry. Tom is a principal and founder in our firm, and I'll introduce him here in a couple slides. Would ask that keep your computer or phone on mute unless you're asking a question. And then we do have in Zoom, we do have a chat feature, and we'll get a little pop-up saying that you'd like to chat, and we'll be able to go from there as well. So today we're going to be talking about the 60-day countdown, and we do every year, why we do it, and then ideal candidates for a captive insurance company. This is the CIC Services team. We are in Knoxville, Tennessee. We are a captive manager. Tom is one of the founders in our firm and should be joining us once his phone comes online. Tom is essentially spent, as I say, 50 years helping business owners really hold on to their hard-earned wealth that they've built over the years. Fantastic to work with. He is a founder and a principal in our firm. This is me, Randy Sadler, and I'll be your host today. I've been here 8 years and helping businesses set up and own their own insurance company. It's been really great to be here. We've tripled in size since I've been here. And I'm also a principal in the firm. My background, very quickly, I grew up in Knoxville, Tennessee, and then went to West Point, was a tank commander in the Army, and that's really, I tell everybody, that's where I learned risk management, where I had responsibility for the lives of soldiers, and then 150 tracked and wheeled vehicles, ammunition, fuel, and safety was paramount. So that's really my background. I transitioned through some corporate roles, in some Fortune 50s, Procter & Gamble and Pfizer being the most notable, and I'm really thrilled to be here at CIC Services. All right, let's talk a little bit about CIC Services. I mean, we are a captive management company, which means we help businesses set up and own their own insurance company, often part of what we call an enterprise risk management strategy, or protecting the entire enterprise. We are full service turnkey, which means we really run the insurance company for our clients. So they own it, but we run it. And our principals have over a century of combined experience in insurance. And you can see on the right, we've been awarded finalist in the U.S. Awards, Independent Captive Manager for small captives, and we're actually up for awards this year as well. And we'll find out next week. We have three awards we're up for this year. First would be the Small Captive Manager of the Year. One of our principals, Sean King, who's an attorney, CPA, many of you probably know that he's leading the lawsuit against the IRS for Notice 2016-66. He's up for Captive Professional of the Year. And then Nate Resnicek, who many of you know, who's Director of Operations in the firm, is up for Emerging Talent. So we're very excited about the team and everybody's hard work to date. So Tom, tell us a little bit about how we help businesses own their own insurance company and how they benefit.
Well, we help our clients, businesses, establish the assets that they need to protect and help them determine what kind of loss reserves need to be established. By owning a captive insurance company, you're going to increase profit. You're going to be in a position where you're able to pass more wealth to not only yourself in retirement years or even future generations, but generally we're able to create through a captive insurance company millions of dollars more than how a business is currently being operated. You're going to have lower costs and more control of your insurance costs. You're going to insure the uninsured risk that you have. There are probably 100 different risks that most business owners have that are underinsured or uninsured. And a good example of that is the pandemic COVID. An awful lot of small to medium-sized businesses are getting really slammed because of COVID, having loss of revenue because of COVID. And then there's a huge benefit from the tax treatment. The government wants to give you an incentive to have a captive insurance company. The government almost pleads for business owners to own a captive insurance company. And the incentive is that they provide you with great tax incentives.
Yeah, very good. Great points, Tom. So today's webinar really is going to address three key questions. The first is, what is a captive insurance company? The second is, what is the significance of the 60-day countdown that we have every year? And who is a good candidate to own a captive insurance company? So let's take question number one. What is a captive insurance company? Tom's going to give us a quick definition. Tom, let us know what a captive is.
Well, a captive it's a real insurance company. It's not an insurance agency or a brokerage agency. It's the same thing as a State Farm or a nationwide insurance company. The difference is that it is regulated by the domiciles, the states where you domicile a captive, as a small insurance company. And under the Internal Revenue Tax Code, it is under Section 831B rather than actually it could be 831A or B. 831A is the captive insurance company, kind of like what Walmart or Federal Express uses to insure their companies. And 831B is designed really for small business owners and small professional operations. And the captives are generally owned by the same economic interest as the primary companies or companies that they insure. For example, if we're dealing with a physician practice, the physician that owns the physician practice would also own the captive insurance company in most situations. And the result of that is that they capture all the underwriting profits, pass through really to the business owner. Captives have been around since the 1950s, and they insure businesses in virtually every industry and sector of the market.
Perfect. Yeah, and if you're just joining us, we're answering three questions. What is a captive insurance company? What is the significance of the 60-day countdown? And who is a good candidate to own a captive insurance company? So we've started on what is a captive insurance company, and Tom just gave a definition. And so let me just let you know, in addition to what Tom mentioned, we might ask the question, what do captives do? Well, they can replace commercial insurance, and often do, and help control lower costs that way. They can insure enterprise risk, which are uninsured, under-insured risk that many businesses face and is particularly relevant to the middle market. They can insure warranties. Many of our captives do just that. They can issue bonds. They can also insure employee benefits healthcare. So a captive doing that can help often lower healthcare costs by about 15 to 25%. And they can do any combination of the above. So very often in the middle market, captives will do several of these, and that creates efficiency for the insurance company. And this is a typical structure. So we have business owner or business owners that own their business or businesses on the left, and they own the captive insurance company. And the business pays premiums to the captive. Now, notice the business is normally going to take a deduction for those premiums paid because they're buying insurance. They transfer risk to the captive, and then the captive is going to issue insurance policies back to the business. Now, remember, Tom talked about how captives receive favorable tax treatment, and so that can be a huge win as well. And we'll talk a little bit more about taxation of captives in a few slides. Tom, what's another benefit of this structure?
Well, a huge benefit for financial professionals is that it creates assets under management. So on the left, the business pays premiums over to its captive insurance company. The captive insurance company accumulates retained earnings to potentially pay claims. And if there are no claims paid or very few claims paid, huge amounts of assets under management accumulate. And so one of the differences in our structure versus most captive managers is that we concentrate on both the left and right side of the balance sheet. We not only focus on what risks need to be insured, but we also help the captive invest its assets in a way that will give it the best opportunity to pay claims if it ever has to pay claims, and also provide the owners of the business the most profits downstream if there are retained earnings to be distributed later.
Very good points. Very good points. So when we think about a captive, remember we're talking about protecting the business from a wide range of threats. And then we're also talking about accumulating those reserves in the insurance company owned by the business owner. So consider that our own federal government encourages middle-sized businesses to be ready for a wide range of threats. This is from ready.gov. It's our federal government's disaster preparedness website. So this isn't even our chart. We just lifted it from them. But notice a lot of the things that they list as hazards that put assets at risk and cause impact often are uninsured, under-insured risks like we talked about. So remember, things like pandemic disease happen to be on their list. And this is from 2015, by the way. So they're very forward-looking. Utility outages, supply chain failure, cyber, terrorism and its impact, very often not insured commercially. Key people quitting the business can really put a business in a tight spot. Reputation damage, very, very hard to insure that commercially, but it can be insured in the captive. How about this one? Regulatory and contractual changes or obligations. So some kind of law changes or a regulation changes, and it creates costs for the business that can be insured. So you can see just from this chart, and by the way, we'll be glad to send you these slides if you'd like them, that our own federal government encourages businesses to be prepared for a wide range of threats. And here are some, Tom spoke to, commonly uninsured risks or underinsured risks. Well, how about litigation? That's a huge one. Cyber, many businesses have cyber policies, but those policies have a lot of exclusions for when they won't pay. Very often, they exclude things like employee error, which is really the largest cause of cyber loss. So if your cyber policy excludes employee error, then you really are widely uninsured for cyber. Supply chain, huge. A lot of businesses are reliant on international shipping, and that can easily be interrupted through tariffs. It can be interrupted through potentially war, through terrorism. There's a wide range of things that can interrupt your supply chain for a business. Fines, believe it or not, we can write an administrative actions policy and help a business insure from being fined. Receivables, a lot of businesses operate with a lot of receivables due in. If a large customer were to go bankrupt perhaps and not pay, that could be a gigantic hit to the business. Receivables can be insured in the captive. Reputation, we spoke about the importance of reputation, and this can be a very expensive claim if a business has a hit to its reputation. There's often a need to sue whoever's damaging the reputation, and then there's a need to advertise and do a PR campaign to restore the confidence of the customer. So that's just a couple of examples of commonly uninsured risk. Now, underinsured, well, a lot of risks are underinsured, and many businesses found out that they were underinsured for pandemic. So when businesses had business interruption, the vast majority have found that their business interruption was tied to their property and was only going to be triggered in the event of property damage. So since their properties weren't actually damaged, most have not been paid business interruption claims, and then some specifically had pandemic exclusions in their policies. Our clients, on the other hand, that have had business interruption losses due to COVID-19 have had their claims paid, and that's largely been because we write fraud form property, which ensures loss of access, not just damage. So if you lose access to your property, your business interruption triggers. And then others have also, whether it was legislative, regulatory, administrative actions by the government, their business interruption claims have been paid. So our clients have gotten the help they needed during COVID-19. So this is a table, and I'll be glad to send you the slides, as I mentioned, of commonly uninsured, underinsured risks, many of which can be protected by a captive insurance company and can then protect the business. Okay, so that brings us to, we've talked about the risk, and we've talked about the benefits of a captive. Tom mentioned that our federal government wants you to own your own insurance company and protect your business from risk. Tom, tell us a little bit about taxation of captives.
Well, on a traditional captive like that, which is owned by most hospitals, large hospitals, universities, large corporations, again, Walmart, FedEx, etc. Premium income is offset by reserves for losses. So they get to take a deduction and set aside money for future claims that actuaries tell them that they could have. And the resulting underwriting profits, along with any investment earnings of the captive, are taxed at ordinary income when they take the money back out, usually 10, 15 years down the road if they weren't used to pay claims. On the other hand, small captive insurance companies, Congress adopted 831B, the Internal Revenue Code, in 1986, and really earlier versions of this goes way back to the 50s, to strengthen small and mid-sized businesses. A lot of this got started with the farmers out in the Midwest because they would try to buy crop insurance, and they oftentimes couldn't get crop insurance, and so they'd have to self-insure. And so what would happen was that a farmer might have to set aside $1 million for crop damage that he couldn't insure. And to do that, he'd have to earn $2 million and pay $1 million in taxes to have $1 million left for crop insurance. So they finally got Congress to pay attention to this. And many years ago, Congress said, okay, we're going to level the playing field. But when we level the playing field, we're going to require that it be done with some limitations. And so originally, Congress passed a law that said that you could take and set aside in your own insurance company up to $1.2 million per year for risk, and you get a tax deduction for that, and it builds up inside your insurance company for future catastrophic losses or other losses. Now, that was a big win for small business owners, farmers, etc. So the huge advantage there is that the income to the captive insurance company is taxed at 0%. So they're essentially able to set aside up to $1.2 million. That was increased to $2.2 million in 2016, I believe, and it's been increased to $2.3 million with the inflation indexing. So the premium goes into the captive on a tax-deductible basis to the business. The captive can receive up to $2.3 million and is taxed in 0% bracket. And then any investment earnings or most investment earnings are taxed at ordinary income inside the C corporation. Captives are C corporations, and all captives have a December 31 year end.
Very nice. So think about what Tom talked about. This allows you to go from being the business on the left, you or your clients, your trusted clients, to being the business on the right. So what we're showing here is two businesses. Everything is identical with one exception. The business on the right forms a captive insurance company to protect itself. The business on the left does not. So the business on the left may have some standard commercial insurance, and the business on the right may actually elect to keep that commercial insurance in the market, for example, but then add all this additional coverage, right? You see things like administrative actions, a government agency fining you, business risk indemnity, which is contract risk. Commercial crime speaks for itself. Cyber, we already talked about, directors and officers, litigation, receivables, losing a key customer. Try ensuring that in a commercial market, very difficult, but businesses often rely on a handful of key customers, and the interruption could force them to lay off employees. So you can actually ensure that with a captive. Key supplier, reputation damage. Catastrophic is really a broad scale business interruption policy that addresses utility outage, natural perils, terrorism, a wide range of ways that a business could be interrupted. So you'll notice we're showing here $1 million a year risk management budget, right? The business on the left simply pays the tax and creates retained earnings. The business on the right owns an insurance company and buys insurance. So notice the difference over 10 years. The business on the right with the captive has almost twice the money, $10.7 million versus 5.9, and has more insurance coverage. So I always often refer to this as captive math, because there's very few places in the world where you get more of everything, right? So normally if you were going to have more insurance, you'd have less money. But by owning the insurance company, you actually get more insurance and more money. And with that, I'm going to let Tom kind of walk through the Excel sheets behind the numbers. This is a summary of forecast.
Yeah, on the left-hand side here, we're showing $1 million of budgeted or potential funds to go toward paying claims. And then in the first section is informal self-insurance. This is without a captive. So this is what a business is doing now. They earn $1 million, and the $1 million gets taxed. So after tax, they've got about $558,000. And for illustration purposes, we're assuming that they've got some legal fees and other expenses that are claims. So we've got $50,000 in claims, and at the end of 1 year, they've got $508,000 to pay claims if they have a claim. They continue to do that over 10 years, earning 6% interest on their investment account, which is hard to do, actually. By the way, this is a best case scenario because it's showing 6% straight line. It's not showing it going up and down like most investment accounts are going to. And so at the end of 10 years, they've got to $5.9 million of accumulated reserves. The middle section is taking that same $1 million and paying it into your captive insurance company and buying insurance to cover risk that might happen. And you can see at the end of the first year, there's $889,000 available to pay claims if something happens versus $508,000 without the captive. And at the end of 10 years, there's $10,700,000 versus $5,000,009. Again, one of the problems with this is that it's the best case scenario. What are the chances you're going to get 6% straight line every year? The far right is using the same scenario with a captive, but using a special investment where we hedge some of that. And hedging means that part of the investment portfolio is going to have a 0% floor. It's going to be a collared investment product, a 0% floor. And then it also has a market rate cap of maybe 12, 14, 15%. So at the end of 10 years, it's got a little bit less, but because of the 0% floor on the investment portfolio, you really probably got a lot more than you would in the middle. And then this is looking at the same type of spreadsheet, but assuming that the business owner kept the captive in play for 10 years, and then after 10 years, let those funds accumulate all the way down to age 71 and started taking retirement income. And that $10,154,000 at age 70 would then generate $708,000 a year after tax, roughly $710,000 a year after tax, for a total of $14 million from age 71 to age 90. By doing a captive, you've actually got about $900,000 that'll come out of the captive after tax for about $18 million total versus the $14 million that comes out by doing informal self-insurance and not owning a captive. And then on the far right-hand side, because this collared product will get about 1 or 2% greater rate of return over the years versus the 6% in the middle section. And it also has some tax advantages on when you take the money out of the captive. And so it would generate about $1.4 million after tax versus the $900,000 and the $700,000 for a total of $28 million. So you can see it's a great product for wealth accumulation, and it's a great product for paying claims instead of paying claims with after-tax dollars.
Yeah, so as Tom kind of covered, remember I talked about having more insurance. Tom really went through how business owners can have more money, which raises the question: what happens to assets in a captive that aren't paid out in claims or expenses to run the insurance company? And the answer is the owner keeps everything. So very, very powerful strategy for businesses. And Tom, what are some of the other benefits? We talked about more insurance, more money. What are other benefits that captive owners can experience?
Well, the business has got a better chance of surviving. Businesses generally don't do well over long periods of time because of catastrophic events and/or they don't, the business owner or key employee dies or something. But it gives you a stronger business model. You improve your risk management, it improves cost control, and it creates insurance profits. It also generates asset protection. The monies that are inside the captive insurance company by law are not available to creditors. It's only available to those that can pay, that can ask for a claim to be paid. And then, as I demonstrated on the previous slide, it generates huge amounts of wealth accumulation if there are no claims or fewer claims. And then there's part of the reason for that is the advantageous tax treatment.
Good, yeah. And so really, we talked about captive insurance company benefits. The big ones are more insurance and more money. And if there's anything 2020 has shown us, mid-sized businesses need more insurance and more money. And when we say more insurance, that also includes covering those uninsured, underinsured risks so that if they had a COVID loss, it would have got paid. Or imagine what could come in the future: terrorism, war, supply chain interruption, electromagnetic EMP or electromagnetic pulse from a solar flare or some other source that would knock out a large section of the power grid. There's a wide range of things that could happen. We have no idea what they are, but we do know is the world is a more and more tumultuous place, and certainly 2020 has shown that to be the case. So this brings us to our second question. What is the significance of the 60-day countdown? Why do we do this countdown every year? So Tom, what's one of the reasons we do the 60-day countdown?
Well, the biggest reason is it takes time to properly form a captive insurance company. First of all, risk assessment's got to be done to determine just what all kinds of risk a business owner's business has. And so we hire a third-party risk assessment firm to analyze the business and determine just what all is out there that could hurt your business. Then it has to be underwritten. A feasibility study gets done with actuary pricing. And once that, and the actuary has to, by the way, we use two actuaries actually. The actuary is contracted, engaged rather, by the business owner and the captive, so that the actuary actually represents the business owner and the captive. And then once we submit it to the domicile, they usually have an actuary on staff that takes a look at it too, to make sure that everybody feels good about the pricing, because pricing can be a place where the IRS gets a little upset with a captive insurance company if the pricing is way out of line. But then the captive formation has to be done by a captive insurance company attorney. There are probably only, I'm going to guess, there's probably only about 30 captive insurance company attorneys that are really on top of what's going on. That's not something everybody knows about. And many of the large law firms do them, though, for the large companies like Walmart and FedEx, so forth. There has to be a submission of a business plan. The captive has to be licensed in the domicile, which is generally a state. You can do them offshore, but we really don't like to do them offshore. The IRS and the government doesn't like offshore stuff. And then there has to be capitalization. You have to put some capital into the business in order for the government to feel like you've got some skin in the game. Premiums have to be paid to the captive. policies are then issued, and then you get a lot of peace of mind because you've got a lot more money socked away for uninsured risk than you did before you had a captive insurance company.
Yeah, very good point. So the first reason that we do the 60-day countdown is it takes time. So if you're a business that's considering protecting yourself with a captive, or you advise or a trusted advisor to businesses, this is a great time to start the conversation to make sure we've got time to complete these steps. And really the second reason for the 60-day countdown is that many businesses are successful. So think about that as a golden goose, if you will, or the goose that lays the golden eggs. And successful businesses are laying golden eggs, right? And what happens usually in October, November? Most businesses are assessing how to allocate those golden eggs, right? And so what are some ways they might allocate those? Well, maybe capital expenditure, CapEx, buying equipment is a common way to allocate golden eggs. Another, dividends or owner profits, maybe, allocating those golden eggs. And then what is the obvious and most logical choice? Well, some of those eggs should be allocated to protect the goose, right? I mean, if we've got this business that's generating golden eggs, it would make complete sense to protect the goose. And that's exactly what a captive insurance company does. I mean, if you think about every year, if you had a goose laying golden eggs, you'd take some of those eggs, and every year you'd build a bigger and bigger wall around that goose. Probably have some guard dogs, whatever it took to keep that goose safe. And so that's exactly what a captive insurance company does. And that's why the 60-day countdown is important, because business owners are thinking about allocating those golden eggs. And that brings us to our third question: who is a good candidate to own a captive insurance company? So Tom, who's a good candidate?
Well, basically, it's any business or any business owner or business owners who have a golden goose or golden geese that are laying golden eggs. In other words, it's any business out there that's making a good profit. And generally it means that they need to have taxable income of about $500,000 in order to have enough in their budget to have a captive and pay the premiums to the captive. Gross revenue of about $3 million, taxable income of about $500,000 would allow about $300,000 going into golden eggs as a minimum. So the minimum's about $300,000. Target really is more like $400,000 to $500,000 for most as a minimum. But the gross revenue can go up. I'm sorry. They can allocate up to $2.3 million into the captive if they have that much surplus, and if they can buy enough coverages.
Very good, very good. So just think about business owners. If you're a business owner and you've got golden eggs every year, or if you advise business owners, one of the things that you should consider advising them on is now is the time to think about protecting the goose or geese, if you will. So this brings us back to those captive insurance benefits and protecting the goose with more insurance and more money. And that's definitely something that the COVID-19 pandemic, riots, international chaos have taught us this year for sure. All right, what's in it for you as a trusted advisor? So if you're an advisor to business owners in the middle market, by introducing them to owning their own insurance company, you can certainly deepen the loyalty that you have with those clients. If you are an asset manager, it definitely can create sticky assets under management. So the assets in the captive insurance company are much more difficult for the business owner to spend, on a boat or a car, etc. So those are assets that can be invested, they can grow, and as an asset manager, they are, as we say, very sticky. And then we also work with trusted advisors, and we do share captive management fees with advisors that we work with. So there really are a lot of benefits to working with us and helping your clients protect their business with a captive insurance company. And so many of you probably remember the old American Express ads, don't leave home without it. Well, really, captive insurance company, don't leave 2020 without it. So if you have brilliant business owners that you're advising, this is the time to really think about forming a captive to protect the goose. All right, that brings us to the end of our webinar. We certainly would be glad to field any questions. I see we've got one in the chat box already. Let me go over there and look at that. But if you'd like to request a copy of the slides, send a note to Tom or me. Here are our emails, and let's see what questions we might have. So let's pull up the chat box here. Come on, there it is. Okay. When a claim is paid, is it taxable? Yeah, great question. So normally, yes. When the captive pays a claim, it is income to the business to address a loss. Now remember that it's normally offsetting a loss. So the loss would be a write-off. The captive claim paid to the business would be revenue in a sense. And would offset the loss. So it should have a neutral impact, but yeah, it is taxable. Okay, other questions? And if you want, you can type them into the chat bar, or if you'd prefer, you can just unmute and ask your question. That'd be fine too.
I have a quick question.
Sure.
Is it possible through your service and getting things created to manage our own funds, manage the funds of the insurance company? I happen to have a couple of businesses that are very profitable, and then I also have a registered investment advisory firm as well. So I'd want to take control of the management of the insurance company funds. Is that possible with you guys?
Yeah, the short answer is yes, it is possible. So just so you know, the captive is a real insurance company. It has assets, and those assets do need to be invested prudently. And so we have Tom mentioned that captives get a license from a domicile regulator. Domicile regulator is normally a state with many of the captives that we manage, and that regulator is going to approve what's called an IPS, or investment policy statement. So if you're familiar with, say, a retirement plan, it normally has an IPS. So you would submit your IPS, we would get that approved by the regulator, and then you'd be able to invest inside the bounds of that IPS. And if you're an asset manager, then you could certainly control those assets. Yes. Is that helpful?
Yeah, very much. Thank you.
Okay. And we've got a couple more in the chat bar here. Let's see. How do we calculate the initial funding of the captive? Would it be the amount of coverage with a multiplier? I'm not completely sure I understand that question, but I'll take a crack at it. And Tom, you might have a good answer for it. So normally when we're forming a captive, we take a client through an education on captive insurance and what it is, and then we normally bring in an independent third party to do a risk assessment, and that risk assessment is going to look at really all the threats that the business has, and then we're going to allocate those based on likelihood of the threat occurring and the impact, right? So we plot that out on really a risk heat map, and we look at the most important risks. Some of those risks may be insured commercially, and the client may want to leave that there. Sometimes that's a better choice, or they may want to replace those. Once we do that, we take the insurance policies that would be formed by that. So if you think about it, we identify the risks, and then we underwrite it. Underwriting essentially means we're turning those risks into insurance policies. So there are some risks we can't insure, for example, because there's just not a way to do it. But once we turn those into insurance policies, then the actuaries calculate pricing. So pricing is really determined by the likelihood of something occurring and the impact. And actuaries use a lot of models to do just that. So that really results in the pricing, and that pricing, it's important that be arm's length. So we use an independent actuary. We don't actually do that. And then the business owner is able to decide how much insurance they want to buy. Sometimes the actuaries may come back with, let's say all their risks could be insured for $500,000, and the business owner doesn't want to insure $500,000. They want to take some risks off the table, maybe lower some policy limits, and only buy $400,000 of insurance. The point is, is that the business owner's not locked into a number. You can always buy less insurance or buy lower limits or take deductibles. So there's lots of ways for the business owner to buy the amount of coverage that's right for them. So hopefully that answers your question, and we'll be glad to address it more offline if you'd like to get on a call or maybe clarify if I missed a couple points there. Another question, and really Tom, you should take this one. Can you explain how hedging works?
Yeah. For those of you that have a life insurance license and have done some advanced sales with life insurance, you're probably familiar with bank-owned life insurance called BOLI. And in addition to that, there's corporate-owned life insurance called COLI. And these are insurance policies that function much more like an investment vehicle than they do an insurance product, other than they have a death benefit that goes with it, and they also are taxed differently. They're taxed under insurance law instead of investment or securities law. And so, like the Fortune 1000 companies, they have 70% of the Fortune 1000 companies invest into the deferred compensation plans of their C-suite executives. They use these kinds of products as an investment. Now, life insurance as an investment cannot be used with a captive unless it is solely for the benefit of the captive. In other words, you cannot use life insurance with a captive to fund estate liquidity or take care of the family if the business owner dies. It's got to be used as an investment only. And so long as it's an investment, legal scholars have all written that it's a great tool to use. So those of you that are familiar with it understand that equity index universal life insurance, for example, has a 0% floor. It's tied to an index, maybe the S&P or some other index. Many of these products have averaged 7 to 8% per year over the last 25 years. And they have a cap, though, that's usually around 12, 13, 14%. And the big advantage is that they grow tax-free. So while it's sitting inside the corporation, instead of having the profits of the investment portfolio being taxed each year, the assets inside the portfolio grow tax-free. So we encourage our clients to put some of their investment portfolio into equity index universal life insurance because it's a vehicle that is liquid, and this is what the regulator's investment policy statement will say. The investment portfolio has to be liquid in case there are claims that have to be paid. They want it to be able to earn interest. Well, in today's market, where can you invest something that's liquid and get a reasonable rate of return on interest? Not very much, 1-2% or so. Also, it has to be low in volatility. The regulators don't want the investment vehicle to be able to lose money. So the problem with if you use an investment portfolio that loses money in a down year, like even this year, if the market goes down, then there'll be a capital call, and the capital calls is made with after-tax dollars, which is not generally very convenient for the business owners. And then lastly, the investment policy statement will allow for the investment portfolio to allow for tax advantages. So to our knowledge, equity index universal life insurance is the only vehicle that allows for liquidity to pay claims, allows for an interest rate that's far higher than what they can get in the marketplace with low volatility, and also allow for tax advantages where the products accumulates interest inside the captive tax-free.
Yeah, very good points, Tom. We have 2 more questions that I see in the chat bar. We'll take these one at a time, and if there's more, definitely continue to send your questions in. This question is, what are the excess limits of coverage? Can you go up to 25 million? Good question. So we didn't cover risk distribution or reinsurance on this webinar. We have covered it in webinars in the past. So what I will tell you is that captives almost always have some sort of backstop. One of the ways that we achieve a backstop is with pooling. So we have 80 captives that all share some risk, and that creates a backstop, if you will. Normally, and this isn't hard and fast, but normally we pool up to $2 million. So that's the limit we normally go with pooling. Now, can we go to 25? Well, normally to go that high, what we would do is go out and find commercial reinsurance. So if you think about it, the captive's going to take some layer of risk, maybe 1 million, 2 million, and then we would look for reinsurers to take above that amount. Now, the advantage of pooling is when there aren't losses, all the money comes back. The advantage of reinsurance is that it often will go to those higher limits, like 25 million. And so if you have a client that needs $25 million of coverage, or you need $25 million of coverage, we'd be glad to jump on a call with you, understand what you're trying to achieve, and see if some combination of a captive and reinsurance can get you there. So hopefully that answers that question, and be glad to dive into it more. The next question that we have,
Randy, let me interject something there.
Please do.
One of the ways you can really save your business owner client money on their casualty insurance is if they have a need for a $25 million claim, because they're willing to take on the first $1 million or $2 million through the captive insurance company. By increasing their deductible, their coverage, we're often able to reduce their casualty premiums with their commercial producer or their commercial company tremendously.
Yeah, very good point. Yeah, so there's, as Tom mentioned, we can do that with a $25 million policy in the commercial market with a high deductible. The captive covers up to $1 million or $2 million deductible, or in some cases we actually write the policy straight to the captive and then put reinsurance on top of it. So very good points there. The next question was, thank you for answering my previous question, is reinsurance required or recommended? Yeah, so I think we sort of just answered that. Normally captives are going to be backstopped somehow. It could be pooled, it could be reinsured, it could be a combination of pooling and reinsurance. So yes, by owning an insurance company, we almost always are looking for a way to pass off some of the risk, especially higher limits, so that the captive doesn't bear the brunt of a claim totally by itself. Yes. Okay. Good. Any other questions? Feel free to type those into the chat bar or unmute and ask them. What is your fee structure? Okay. To make sure I got that. Yeah, what is your fee structure to manage the captive? Fantastic question. So it largely depends on the size of the insurance company and the complexity. So think about what we mentioned, that we use some independent experts that work for the captive and we coordinate them. That would include captive attorney, underwriting actuary. Obviously, captives have tax and audit that has to be done each year. There's also the cost of licensing the insurance company, and then our work as a manager to coordinate that and keep all the books. So just to give you a kind of a short answer, $45,000 on the low end for setup and every year to run the captive. That's a good number to start with. And typically on the high end, maybe $100,000 setup and $100,000 a year to run the insurance company. Now there may be some that are very big and very complex that might go over that, but the vast majority of our captives are going to fall in that 45 to 100 range. And then we've got another question. Is there a monetary level that will allow a captive to not have to pool? Okay. Is there a monetary level? So really the key to not pooling, if you don't want to pool normally, is to have more entities. So the IRS publishes 2 safe harbors on risk distribution. We didn't cover that in this webinar. We've covered it in quite a few other ones and can cover that on a call. But normally, if you have 12 or more entities and they're not disregarded, then a captive can ensure distribution by insuring those 12 or more entities. If you go back and look at, so say, the Rent-A-Center case, they had multiple subsidiaries that all had individual tax returns, and that achieved distribution. That's one way to do it. Otherwise, tax court cases or case law, as few as 7 entities could be counted as pooling, although, or as distribution, although we recommend just following the IRS safe harbor. Now, one other point, there is a way of assessing distribution by assessing the number of statistical exposures. So in a warranty program, for example, where there are lots of parts or machines or cars being insured, each one creates a unit of exposure. And so many warranty programs aren't pooled, for example. So, businesses that have a lot of exposure units can achieve risk distribution without pooling. All right. Other questions? Oh, we got another one. Okay. I am entertaining a possible acquisition by a foreign company. Is the captive a subsidiary or a well-defined independent company? Very good. Normally, especially for middle market businesses, the captive is a separate company. So if you kind of think back to our structure, where the business owner or owners own the business or businesses, but then also own the captive. Now, sometimes that captive might be put in a trust, or it might be in a holding company. But it very often is separated out from the companies that it is insuring. In a middle market case, very often we have business owners that sell their company and then keep the captive, surrender the insurance license, and all the money in the captive is theirs. There are cases, however, where the business owns the captive, or a holding company owns the business or businesses in the captive, and you sell all of it. So you could theoretically sell business with captive. You could sell business without captive and essentially keep the captive. Hopefully that answers that question and what you were trying to achieve. Okay. Any other questions? You've got Tom's contact info, my contact info. If you have any desire for a conversation, definitely reach out to us, email. You can call us 865-248-3044. We'd be honored to work with you. And thank you so much for joining us for today's webinar. And as I said, when you think about your clients, don't let them leave 2020 without a captive. All right, everybody have a great day. Bye-bye.